Okay, so the ratio at the end of the chapter is this interest coverage ratio. And again, what it's trying to answer is how able is your company to be able to pay back debt? Okay. So again, this payment of debt is a key theme for a lot of these ratios because that's such an important and critical question to answer, both as if you're a lender to the business, of course you're going to care about that, but also if you're the owner of the business, because your equity is going to get wiped out potentially if you're not able to pay off your debts, right? That's when a company goes into bankruptcy. What this ratio is trying to answer is how much income is there to support interest payments. So it's like if you have credit card debt of say $10,000, who do you feel better about if you had to lend another 10,000? Would you feel better about lending to someone who has uh, $500,000 in earnings per year, or someone that earns $40,000 a year? Who is the better person that you're going to lend to, given that each have $10,000 in debt? It's obvious, right? Hopefully, yes. The person who earns more, there's going to be more coverage of the debt, right? They're earning a lot more. They're much more able to service the debt if you're earning more. Okay, so that's what this ratio is trying to figure out. Now you're going to add back certain things. You're going to start with net income. You can see here, but you're adding back tax and you're adding back interest expense because you can think about it like this. You're going to have your revenues. You're going to have your operating expenses. Okay, so let's say this is 1,000. This is 400. That means your operating income is 600. This is how much your business generates. From this, you're going to pay first interest expense. Let's say it's 50. Now, interest is tax deductible. Okay, so your tax expense is based on this. It's based not on your operating income, but it's based on how much you earn after paying off your interest. Okay? And then you're going to have your tax expense. Let's say it's another 10. This gives you your net income. So what we care about is not your net income. We care about how much money you have to pay your interest. So we're going to go back to here by adding this. And then we're going to go back to here by adding this. Okay, so that's what this is. So you start with your net income, you add back income tax, and you add back interest expense. And that gives you the pool of money available to service your debt. And then you divide that by how much interest you have. So you can see here, we have $600, and that pool is available to pay this $50 of interest. So it's a quite high ratio, 600 divided by 50, 12x. So if you're a lender, you're going to feel quite comfortable giving another loan, at least on an interest expense basis. Okay, this is not capturing how much principal, right? You're borrowing, because let's say this interest expense is they've somehow during COVID they were able to borrow and they have, this is 1%, so times 100, so 500, 5,000. So this is on $5,000 times 1%. Okay, this amount is a lot compared to this 600, right? So on a principal, how much principal balance they have, maybe you're going to be like, oh, I don't like that. But we had another ratio for that. We had the debt ratio, right? That's going to capture that question of how much total debt do they have um, compared to their assets. That's going to answer that indebtedness question in a different way. This is just looking at how much cash flow to keep the debt out of default, right? And that's going to be dependent on both the amount and the interest rate that you're paying. So you have to understand this question of indebtedness in various perspectives, both from a total indebtedness perspective and from a cash flow, being able to pay the debt and make sure it's not going into default perspective. Those are both important questions to answer.